Hey everyone, and welcome back to Dollar Basics. Today, we're diving into one of my absolute favorite topics, index funds. You've probably heard people call it the lazy way to get rich, and honestly, they're not wrong. But how does it actually work? And can it really make you wealthy? Stick around, because we're going to break it all down. Let's start with a little story about two friends, Robert and James. Both start with the same amount of money to invest. Robert is a go-getter. He spends hours every day researching stocks, trying to find the next big thing, buying and selling, trying to time the market perfectly. James, on the other hand, takes a different approach. He puts his money into something called an index fund. Well, he pretty much forgets about it. He goes on with his life. Who do you think ends up with more money after 20 years? The answer might surprise you. So, what exactly is this magical thing James invested in? An index fund is basically a giant basket that holds tiny pieces of many different companies. Instead of you trying to pick individual winners like Apple or Amazon, the fund just buys all the stocks in a particular market index. Like the S&P 500, the S&P 500 is a list of the 500 largest publicly traded companies in the US. So, when you buy a share of an S&P 500 index fund, you instantly own a small slice of all 500 of those companies. It's diversification made simple. You're not betting on one horse, you're betting on the entire race. Now, let's get back to Robert and James. Robert is what we call an active investor. He's trying to beat the market. The problem is, that's incredibly hard to do. In fact, studies showed that over 92% of professional fund managers people, whose full-time job is to pick stocks fail to beat the S&P 500 over a 15-year period. Over 20 years, that number climbs to about 95%. So, if the pros can't do it, what makes Robert think he can? This is why index funds almost always win in the long run. They don't try to beat the market, they asterisk the market. By owning an index fund, your returns will essentially match the market's performance. And historically, the S&P 500 has returned an average of about 10% per year. That's a powerful number. Another huge advantage is cost. Those active fund managers Robert is paying. They charge high fees, often 1% to 2% of your investment every year. That might not sound like much, but it eats away at your returns over time. Index funds, however, are famous for their ultra-low fees, called expense ratios. For example, the Vanguard S&P 500 ETF, ticker VOO, has an expense ratio of just 0.03%. Fidelity's version, FXAIX, is even lower at 0.015%. Some, like Fidelity's FZROX, have a 0% expense ratio. Lower fees mean more of your money stays in your pocket, working for you. Even the legendary investor Warren Buffett is a huge fan. He famously made a bet that a simple low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over a decade. The result? The index fund returned 125.8%, while the sophisticated hedge funds only returned about 36%. Buffett won the bet, hands down, proving that for most people, simple is better. The real magic of index fund investing happens when you combine it with a long-term mindset. Let's talk about compound interest. At that historical 10% average return, your money doubles roughly every 7.2 years. But what happens if you try to be clever like Robert and jump in and out of the market? Let's say you get nervous during a downturn and sell, but you miss the 10 best days of market recovery over a couple of decades. Missing just those 10 days could cut your total returns in half. That's a massive loss. The secret isn't timing the market. It's time asterisk the market. So, how can you start today? It's easier than you think. First, you need a brokerage account. There are many great user-friendly options out there. Once your account is open, you can search for a low-cost index fund. Popular choices track the S&P 500 or the total stock market. You can buy them as mutual funds like FXAIX or as ETFs like VOO. The difference is minor for most beginners. The most important step is to start, even with a small amount, and to be consistent. Set up automatic contributions if you can. Now, let's cover a few common mistakes to avoid. First, don't panic sell. When the market drops, it feels scary, but that's often the worst time to sell. Remember the long-term plan. Second, don't chase past performance. A fund that did great last year won't necessarily do great next year. That's why betting on the whole market is safer. And finally, watch out for those fees. Always choose low-cost index funds. So, here is your action plan. Step 1. Open a brokerage account this week. Step 2. Transfer some money into it, whatever you can afford. Step 3. Buy shares of a low-cost broad market index fund like VOO or a total stock market equivalent. Step 4. Set up automatic monthly investments. Step 5. Go live your life and let your money work for you. Just like James, investing in index funds is truly a powerful strategy for building long-term wealth. Without the stress of trying to pick individual stocks, it's simple, effective, and proven. So, what are you waiting for? Thanks for watching. If you found this helpful, please hit that like button and subscribe to Dollar Basics for more simple guides to managing your money. Let me know in the comments if you've already started your index fund journey. See you in the next video.